Hi, I'm Jimmy. In this video, we're looking at Facebook stock, also known as Meta Platforms, ticker symbol FB. The goal of this video is to look quickly at Facebook's business. We're going to look at some of their segments, then we're going to try to come up with a fair value for Facebook stock using discounted free cash flow. And ultimately, we're going to see if, because of the gigantic stock drop, the price of the stock dropped over the past couple days after earnings came out, is it now worth buying? Okay, so let's jump right in. So these are Facebook's two primary segments. Their smallest segment, and the one that they're really banking the future on, is their Reality Labs segments. This is where they're planning on the metaverse, as they changed their name to Meta Platforms. Well, this is where that revenue will reside. Right now, the 2% of revenue that this is generating is primarily coming from their virtual reality hardware, things like the Oculus. So Oculus, they bought back in Facebook bought, I believe, back in 2014. They paid like $2 or $3 billion for it, and it's a very cool headset. I've used it, but it's a very small piece of their overall revenue. Clearly, their family of apps, which includes things like Facebook, Instagram, Messenger, WhatsApp, things along those lines, is what's driving their overall revenue. But at the end of the day, it is the Reality Labs that Facebook is primarily banking its future on. So that's the core of the business. But right now, the Reality Labs business is not terribly profitable. It's not profitable at all. In fact, it's losing money. Yes, it is generating 2% of revenue, but from a profit standpoint, right now it's a drain on profits. Now, Facebook is making the case that that is not that big of a deal, because when we look at their revenue, well, their revenue is quite large. These are quarterly numbers going back to 2015, the first quarter of 2015. And one of the things that really dropped or tanked Facebook stock is that when they came out with earnings, their earnings numbers was about 20%. Plus, margins dropped a bit. Now, that 20% growth was lower than expectations. Granted, it was above what second quarter of 2020 was, but I think that the thing that people realized is that in order for Facebook to grow their metaverse, to grow this line of, nope, not that one, to grow the Reality Labs line of business, they're going to have to spend a lot of money to get there. And this isn't something that's right around the corner. Now, one of the other things that I think is important to point out is that, by the way, this is a chart of their growth year over year, just in case we didn't realize what it was. They had 20% growth, which was lower than expectations. But one of the things that is putting pressure on their growth is the fact that Apple recently changed their privacy policy, basically allowing users to opt out of some of the specialized ads that companies like Facebook really lean on, because if they can get more specialized ads, they can charge more money for those ads. Now, Facebook has come out and said that they estimate, because of this policy change, this could lower their revenue by $10 billion over the course of the year. Now, when we switch over to their revenue, their annual revenue numbers, well, we could see that, by the way, these numbers are in billions of dollars. So we could see last year they put up about $118 billion. These green bars are analyst estimates. So analysts are expecting for this company to continue to ramp up. But what Facebook has come out and said is that because of Apple's policy, well, these numbers could be even higher. But because they're not allowed to use specialized or as many targeted ads, well, that's going to hurt their overall revenue. Okay, now let's see if we can come up with a fair value for Facebook stock using discounted free cash flow. So this is our calculation for Facebook's fair value using discounted free cash flow. And before we go any further, I just want to point out that this is actually a template that we're using to build a website where all we would have to do is punch in a ticker symbol, and that ticker symbol would kick back the analyst estimates for Facebook stock. It would also tell us how many analysts are covering that particular stock, how many analysts are projecting for that particular year. In theory, the more analysts that we have, the better. That will then kick back a fair value using our required rate of return. I'm using 7.5%. So I just want to point out that this website is getting ready to go up and be live. It is not live yet. We have consistently said that we're expecting this website to be up and running by the second quarter of this year. So the end of the second quarter of this year is when we're planning to have it up and running. We're hoping to get it before then, but that's what we're planning on. And if you sign up today, well, we're locking in the price, so the price will never go up on you. And so, yeah, I will leave a link in the description below for how to sign up for that website if you're curious. But for now, let's jump back to Facebook. So, for Facebook, we can see that the current price is about $237. We are calculating a fair value using 7.5% of $397. Like I said, we're using analyst estimates, and we can see that the number of analysts, we have plenty of coverage for the number of analysts. But a more textbook required rate of return, I often get pushback on my required rate of return of 7.5%. A more textbook required rate of return would be to use something like the weighted average cost of capital, which basically takes the company's own cost of debt and their cost of equity and says, okay, this is how much they have to earn for, that's the company's own cost of capital. So basically, we want our number. You can use that as a required rate of return. If you don't know what required rate of return to use, that's a great default number to use. That's what most textbooks will tell us to use. Well, even using that, it's saying that this stock is worth $304 per share. Now, even if we wanted to use a higher required rate of return, let's say we wanted to use 10%, well, the 10% number still says the stock should be worth $266 per share. Again, it's trading at $237. So, considering how much growth we have in the company, again, if we go back to their revenue, look at the growth. They have gone from less than $20 billion in 2015. They're estimated by 2023 to be over $150 billion. That's $156 billion is what analysts are estimating. And the stock reacted by tanking the stock price because analyst estimates were, because revenue projections came in a little bit lower and margins were compressed. But part of the reason for that is when we look at what they've got going on with their different lines of business, well, the Reality Labs business is going to drain their margins in the near term because that's going to be purely an expense. They're not going to bring in a ton of profits with that business. Luckily for them, they've got so much revenue generated in their ad generation from their Instagram and Facebook and WhatsApp. There's so much money being generated over there that they can almost afford to sit here and wait for their Reality Labs business to ultimately grow. That being said, I have said many times on a lot of my videos that I do not plan on buying a stock unless I first say I'm going to buy it. Now, after this Facebook pullback, if the stock stays below, let's say, $250 per share over the next week, I do plan on adding Facebook or Meta platforms to my portfolio just because, one, I think it's a great value now. I mean, right now, the PE of this stock is 17x. Just to put that in perspective, the S&P 500 right now is trading at about 23x. Microsoft is trading more than 32x. Apple is trading up at 28x. Microsoft, Apple, two companies I would love to own, I would love to buy. I would love the growth that they bring to the table, the stability that they bring to the table. Now, I don't think Facebook is nearly as stable as those businesses, but they are generating a ton of revenue and a ton of free cash flow. I mean, look at their free cash flow estimates down here. They're putting up huge free cash flow numbers. So considering we can get this stock right now at 17x, I think that this is a very smart buy. And this is one of those stocks I was super excited when I plugged this in our calculator and it came in higher than the current stock price. But this is something that I was super excited about because I'd love to add a little bit of growth to my portfolio. So, that being said, I plan on adding Meta platforms to my portfolio over the next week as long as the stock doesn't completely recover and get above, let's say, $250 per share. Besides that, if you'd like to sign up for the website, I will leave a link over here and in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.